Welcome back to the Talking Stocks podcast, where Todd and I talk stocks. Todd, happy Friday. It's been one hell of a week, hasn't it?
Oh boy, I tell you, it's been crazy. It's been a crazy week for the markets. It's been crazy here in the Northeast.
Oh yeah, we both lost electricity and internet at our respective homes this week for, I don't know about you, we lost it for over 48 hours here. Was not pleasant. Had some water in the basement. It's been a rough week, man.
You know, I tell you, growing up, Joe, I never worried about these storms. Now I can't get a wink of sleep. It sounded like a train rolling down the front yard and these pine trees swaying.
Oh yeah, it was a rough week, and it seems like the market, I don't know, caught wind of our bad weather or something, because it has been quite the sell-off, huh?
Well, maybe it was a good thing that we were without power. We couldn't be checking our portfolios every 10 minutes.
Yeah, I certainly didn't miss it. It was, it's been a rough week. That's all I have to say. So I feel like we had this same conversation last week about why is the market selling off? But I feel the need to ask you the exact same question again. Why is the market selling off? Is there a clear reason? Is it just kind of natural movement after a long rally?
I really do think that we're in the midst of a business cycle correction, so rotation. So it's not necessarily let me get out of everything. It's more like, okay, let me get out of the really high growth, speculative, pre-revenue stuff that's up 100% in the past 52 weeks, and let me rotate maybe to these cyclical areas of the market that would tend to do well in the mid to late cycle of the business cycle. So, you know, when you get that rapid growth in stuff at the beginning part of GDP expansion, and now I feel like people are modeling more for that maturing of the GDP expansion 6 to 12 months out. And then also factoring in saying, okay, well, the Fed has said they want to be really, really accommodative. They don't want to just hike to hike. And I think some people are interpreting that as being, okay, they are going to take their time on controlling inflation. What happens if they wait too long? And then they're behind the curve and they have to slam on the brake harder than they might otherwise if they got out in front of it. So I think people are kind of thinking about all of these things, and then they're looking at their portfolio and they're looking at these areas of their portfolio that have become very, very large, you know, weighting wise, both as a sector or as industry or individual stock. And they're saying, I need to yank some risk in and maybe reallocate some of this money to some of these other more beaten down, forgotten baskets. And Joe, we can pull up this week's research if you want, but I mean, we're certainly in the sector work that we do every week. We've certainly been seeing that since December, right? We've been seeing, you know, more of these aggressive parts of the market sort of sliding down in the sector ranking, and sort of these forgotten areas of market, energy, of course, being a big one, lifting up. I mean, energy in the middle of January, I think it was January 16th, the energy sector was the number one sector in our large cap ranking. Who was talking about energy in the middle of January? I didn't even want to believe that move, right? Nobody wants to believe that move, and everybody's underweight it. But sure, if GDP is rocking, you're going to demand more energy products, right? It's going to support crude oil prices, and sure enough, that's going to flow into inflation. So, you know, it'll be interesting to see if that move has legs. But I think that that's really what we've been seeing here, is we've seen this de-risking of the portfolios away from these more speculative areas into some of these mid to late cycle plays.
Yeah, just looking at the watch list that I have up in Active Trader Pro, which is obviously it's not balanced by sector or anything, but just looking, there's a very clear gap, and about 2/3 of the stocks I have in here, I have 50, are up, and about a third are down. And the ones that are down are companies like Tesla, Teladoc, Stitch Fix, Shopify. The ones that are up over 3% are Wayfair, Intel, that's a bit of a strange one, Procter & Gamble, IBM, Microsoft, much more kind of stable stocks that, as you said, have been overlooked a little bit in this rally. I know some of those that I just listed off, I own, and they've been laggards since the beginning of the year. And I tend to be drawn toward those more stable stocks, and as a result, my portfolio has honestly been lagging a little bit since the first of the year, at least compared to the overall market.
Probably even earlier than that, Joe, because I mean, if you look at some of the FANG stocks, so you're looking at names like Apple or Amazon or whatever. I mean, you look back at some of those stocks and you say to yourself, wow, those have gone sideways. They really haven't gone anywhere since September. So, you've got a 6-week basis in a lot of those kind of big cap techs. And maybe that's one of the reasons, like I noticed that Facebook was sort of trying to, climb a little bit this week, even as other stocks were falling. And I was like, well, maybe if people are saying, okay, for my tech exposure, I'm less interested in something that's a high flyer like a Tesla at this point. I'm more interested in something more like a Facebook with more predictable 20% revenue growth and less uncertainty. I mean, Tesla, just to I'll share my screen because I think it's interesting. And Joe, you can see that okay? So let me pull up Tesla.
Yes, I can.
All right, so I'll pull up Tesla. And, you can look at Tesla's chart and just, geez, what a double diamond ski slope that is, right?
Whee!
Yeah, 900 at the peak up here in late January to 587. Today getting as low as 540 earlier today. And I think that, there's so many of those stocks that look very similar to that. I mean, it certainly is a good reinforcer of what we had talked previously. We did a show in December where I was talking about how I had sold some of my Tesla when it got added to the S&P 500. And, now that looked pretty stupid for a little bit as it ran up to new highs all the way into the end of January. But in reality, it's prudent risk management, right? Reduce my exposure to the name, assuming that we would get something like this. I've been spending, I don't know if Joe, have you been spending any money this week?
I spent a little bit of money this week. I wish I had more cash to deploy right now, because I'm looking at every day. It seems like I pull up my watch list and I'm like, oh my gosh, that is like $50 off its high. I want to buy that and that and that. But yeah, I did. I bought Etsy this week. Bought it at probably not a very good time, but I know it'll go up eventually. I'm down like 12% on it right now. Not thrilled. I bought it on Wednesday, I want to say, after earnings, the day after earnings was. And yeah, it's been somewhat of a precipitous drop. I've said for really ever since I started investing, there seems to be a pattern, and whenever I buy a stock, it goes down. So I should probably tell people when I buy a stock that they should wait a couple of days, because it seems that whenever I buy a stock, it goes down like 10% very shortly after I buy it. So yeah, I'd say maybe buy Etsy like now. Since it's gone through that 10% drop after Joe buys cycle.
Yeah, well, what's interesting is you get a lot of stocks that are breaking the 200-day moving average. Down here, this is black line. You still have a pretty good distance to the 200-day on Etsy, but Etsy's been holding up relatively well comparatively, compared to some of the other stocks, like the high flying CCIV type stocks that went from 65 to 20, right? So comparatively, Joe, Etsy's hanging in there pretty tough, and high scoring in our research, revenue growth of 130% year over year in the December quarter. In 2022, looking at 25% EPS growth from 2021. I mean, those are all numbers we talk about every week on the numbers we like to look at in the show. And, Etsy obviously checks those boxes. And I think one of the things that's interesting, Joe, about these kind of markets when you get these pullbacks, and you're never going to get the bottom, right? I mean, it's very, very hard, unless you're like hindsight, right? Time machine, to figure out, you're not going to get the bottom. So, the goal is to kind of leg into them as they're falling towards support levels and to keep a little bit powder dry. And I think, we had that great show that you and I did a few weeks ago talking about different buy points and how I approach things that are on my watch list. So you look at the 21 day and you say, okay, well, it failed the 21 day. So now we'll take a little bit more at the 50 day, right? And then theoretically, you would hold out a little bit of money back and say, okay, if it gets down here, you know, that 145 area, maybe I would take a little bit more there. So you can kind of break it up. You don't have to go all in when the market's retreating, because it's very hard to, actually, that's a good thing. I'm going to stop sharing this screen because I want to swap over to another program that I use that'll be a little bit more instructive on the point that I'm just about to make. So I'm going to go ahead and share my Fidelity chart screen. And Joe, let me know if you see that QQQ chart.
Yes, I do.
Okay, great. So, I mean, obviously this is a 2-year chart now of the QQQ, which is the NASDAQ 100. So 100 of the biggest stocks in the NASDAQ. And you can see this monster move, obviously, we've had since March of 2020, rallying all the way up to from about 170 near the low in March last year to 330. So almost a double, 90% return or so over the course of the last 12 months. Not bad, right? And then you've got this very sharp sell-off here. Now, I want to zoom in on that sell-off. So we're going to go to the, let's see here. Let's go to the 10-day chart. Yeah, I think that this is a little bit more instructive. Actually, I'm going to go a little further out. I'm going to go to the 1-month chart with 30-minute intervals. So you can see here, Joe, where we're putting in that high up here at the end of, early February 12th, somewhere around there, 338, right? And, you know, everything's fine. I mean, these are all normal, you know, volatility, okay, 330 to 338, bouncing around, bouncing around, bouncing around. And then it started to get a little tricky and a little bit dicey, and it started to fall. So we had talked to the show. I'd raised cash. I got about a little over 20% cash. I'm now fully invested. For all intents and purposes, I'm fully invested. Now, when I do the post-mortem of my trading from this experience in another couple of weeks, one of the things I'm probably going to beat myself up about is cheating a little bit. So, you know, I believe that it's important to plan your trades. So what I did is I looked through my list and I said, these are the stocks I want to buy, and these are the stocks I want to pay. But what ends up happening is you can see how we fell here, rallied, fell here, and then had that big volume day and rally. I cheated and bought some stuff a little bit above where I had set my target prices. In my post-mortem, I'm going to beat myself up about that because I really shouldn't have done that. Then you pull back again, you rally, stop here, fall again, but you still have higher lows. So, okay, well, maybe I'm okay. Rally again, roll, sell off, break that low. And that's a scary thing when that happens, because now you've bought each one of these thinking, okay, higher low, higher low, higher low. You've committed more cash maybe than you wanted to. Now it's rolling over on you. A lot of those buys you just made are now getting pretty ugly. And then you make another new low, and then you get bailed out again. Rally, 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 and you're feeling smart again until, of course, it breaks and it breaks and it breaks and it breaks. And then hopefully today, I did feel a little bit like, you know, a broader puke in the market, hide under your desk kind of movement. But I think that one of the reasons I wanted to show that chart and just kind of walk through that is that, you know, there is no bell that rings to signal, hey, this is the absolute bottom. This is where you need to be committing your money. And if you're not careful, you can get a little out ahead of on your skis. And I think that, like I said, in my postmortem, I think that's what I'm going to determine is that I got a little bit too far out ahead of my skis. And I probably should have done better about dividing up my buys into 3 different tranches. Again, the 21-day, the 50-day, and the 200-day, so that I would have had a little bit more cash to deploy yesterday and today than I did. I only had probably 6 or 7% cash left, Joe, for yesterday and today. And honestly, it would have been great if I had, you know, twice that, right? So I think that's kind of instructive. Definitely, you know, tough day. It's a great reminder. We're going to have periods like this, right? It's why on the show, we talk about not having margin, not using leverage so that we can have a clear head. We don't have to worry about the broker calling us and saying, you've got to make good on your margin. We don't have to worry about forced liquidation. We can have, you know, whatever our version of diamond hands is, we can have that. You know, and I think that it's also instructive and a good reminder, because I don't know if Friday bottoms are tough, Joe. Usually you don't get them on Fridays. Usually it's Mondays or Tuesdays. So I don't know how we'll close or how we'll open Monday or Tuesday. I feel like we're getting close, but we may not be there yet. Not a bad reminder to do a little self-care, go for some walks, stop looking at your screen all the time. Don't watch tick by tick. Trust your process, trust your discipline, trust your rules.
Yeah, well said. So going off of that, I know you wanted to spend a little time in today's episode talking about research and due diligence, because you know we always say that you don't want to fall victim to that emotional decision making, and so the best way to do that is obviously to have a thesis, like we've said many times before. Now, we're not talking about, you know, that concise sentence that your high school teachers always said that you had to have in all your essays. We're talking about just a reason for buying a stock, not just we like the stonk or everybody's talking about it on Twitter. So take that as you wish. Take it take it and run.
Yeah, you know, I think that one of the things that might be helpful for anybody, I mean, there could be a lot of people who are really interested in the markets, have been waiting and now want to get involved in the markets now that, you know, they've pulled back a little bit. Or it may just be good to kind of go over this for people who are more experienced and want just a reminder, have a simple framework that's repeatable, that they can use to evaluate, find and evaluate stocks. And this is in a nutshell what I'm going to share in this next segment. In a nutshell, is what we teach in our course, How to Talk Stocks at the University of New Hampshire, where we kind of walk an entire semester through a particular stock and we cover each one of these pieces of the framework. So I want to share my screen. And again, this is a simple framework that you can use to evaluate stocks, come up with your thesis and your conclusion on whether or not you want to buy, sell, or hold. So I'm going to go ahead, share my screen again, and we'll go over to the Word doc I made. Just sort of walk through. And Joe, I'm assuming you can see that simple stock framework?
Yes, I can.
Okay, great. So, I mean, step one is find a stock, right, Joe? I mean, find a stock. So, I mean, Joe, when you decided you wanted to buy Etsy, how did you even know Etsy existed?
How did I know Etsy existed? Well, people, how do I go with that? People talk about it on FinTwit a lot. Comes up in general market news every once in a while. It's a pretty well hyped stock. I'm familiar with the website. I know some people who sell stuff on Etsy, so just kind of a familiar name, I guess, somewhat of a household name.
Right. I mean, for me, I became more and more familiar with Etsy when boxes started showing up from these artisans. And I was like, asked, how did you buy these things that are coming from California? Etsy. Oh, interesting, right? So find a stock, look in the world around you, right? What are the products, the brands, the services that you love? And, you know, or look at work and say, what are the products and services that we use at work that are just indispensable to me and how I do my job? So find a stock. So look in the world around you, your world around you, and, you know, come up with a name that is intriguing to you. So that's step one. Step two, figure out, how does it make money? How does it make money? And Joe, the easiest way to do that, in my opinion, is to take a look at the 10K, and you can get the 10K on the investor relations portion of almost every publicly traded stocks website. So you go to you go Google investor relations, Etsy plus 10K or SEC filings. And when you open up that 10K report, there's going to be a hyperlink to business. Click that hyperlink business. And it's going to give you 2 paragraphs where it talks about, this is our business and this is how we make money. So it'll say, you know, if you've got a company like Etsy where it's uniting these creators with consumers and it's taking some portion of a fee in the middle, right? or it could be a software. It's a software company where people buy it once and it's one and done, or it could be software as a service where people pay a subscription ongoing to it, or it could be any kind of a mix of that. But you need to understand, how does the company, or it's Starbucks, and it's making its money by selling you coffee every day and hoping that you may buy a muffin or maybe a sandwich every once in a while, right? So understand how the company makes money. That's step 2. Step 3, how big is the addressable market? Okay, how big is the addressable market? And you can just Google it. You can Google e-commerce, and for example, for Etsy or Shopify or any of those kind of companies, or Amazon, and you can just simply Google e-commerce sales quarterly, and the retail sales report that the government puts out every quarter will come up. It'll show you exactly how much money is spent on retail, and what proportion is e-commerce right now. And it's like, teens to low 20s of all retail sales. So again, how big is the addressable market that the company is targeting? Because you're trying to get a feel for, okay, is this a young company that's just, getting going and has a lot of running room? Or is this a very mature company and it's already pretty much maxed out its opportunity within that particular market? And then kind of as a part of step 3, Joe, is why will it win? What does Etsy or some other company do better than their competitors? What is it about that company that makes you think it can win? And it can be just products that are in the pipeline. It can be existing products. It could be anything. But why will it be the one that's going to be the winner within that big addressable market that it's targeting? Does that make sense so far, Joe?
Absolutely.
All right. So the next piece of the puzzle, step 5, is analyze the risks. We spend way too much time on FinTwit in our echo chambers, right? I love stock. I love stock A. I love stock A. So do I. So do I. So do I, right? And we spend very little time thinking about what could go wrong with those stocks. In that 10K that you already looked at to find out how does the company make money, there will also be a section on risks, where some of the risks are just going to be boilerplate, risks that every company is going to include for legalese, or whatever. But if you read through those, you will get a good feel for what could go wrong for the company. And what I always tell my students is, pick one, whatever you think is the big risk. And we use something called PESTLE, which if you Google it, just Google PESTLE, and it'll walk you through the different components of that's an acronym. So pick one big risk facing the company and then answer to yourself, okay, this is the big risk facing it. How will it overcome it? So for example, we have students all the time that pick Tesla as their company, and invariably they come back and they settle on the big risk that is facing them is technological innovation with batteries. Will they be able to maintain their lead in batteries, right? Because that could be the key differentiator between buying something from Lucid or something from Fisker or something from Tesla in another few years. So that's the question you'd want to answer, right? You'd want to say, okay, well, how can they maintain that lead in batteries, right? Step 7, financials. And really, Joe, I like to try and keep it simple. As you know, I like to look at the balance sheet. I just like to look at the cash, and I like to look at the debt. Do they have more cash than they have debt, more debt than they have cash? And how has that changed over the past year? Is their cash increasing? Is their debt decreasing? So just those 2 things on the balance sheet. And then on the income statement, look at the year-over-year change in revenue, operating margin, and earnings per share. So revenue or sales, that's obvious. That's how they make their money, right? Are they making more money this year, bringing in more money as a business than they were the year before? And again, you can get this in the 10K, but in this case, I actually look at the quarterly numbers. So then you would want to, instead of looking at the 10K on the investor relations portion of the website, you'd pull up the 10Q. So the 10Q is the quarterly report. And all this information will be contained right inside of it. So you look at the revenue and say, okay, is the revenue growing versus last year? You can calculate the operating margin, right? So basically, are the margins at the company expanding Like, are they able to leverage let's assume the company's got sales that are growing. Are they able to leverage those increasing sales against their fixed expenses so that their margin is improving? And then where the rubber meets the road for all investors is, as shareholders, we are theoretically entitled to our share of their profitability. And that's best reflected as earnings per share. So are their earnings per share growing? Is the company's earnings per share growing or shrinking? Once you've gone through those 7 steps, you should then be able to make a conclusion. Do you want to buy? Do you want to hold it, put it like on a watch list, if you will? Or do you want to sell it short or just ignore it? And it doesn't take a tremendous amount of time. Once you have that framework written down and you go through it, it doesn't take a tremendous amount of time. You can digest a lot of stocks over and over and over again using that simple framework.
Absolutely. It is pretty simple. And if you don't think it's simple, my response to you would be, well, it's your money. How much do you care about your money? How much do you care about your hard-earned wages, your retirement savings, whatever it happens to be? You know, if you look at that and you're like, oh, 8 steps, that's a lot of work. Yeah, it is. But also maybe you just shouldn't be so lazy and you should care about your money a little bit more, because if you don't do that research and you're just buying based off of what you see other people buying, or even worse, what you see other people talking about, then you're going into it just utterly uninformed.
Yeah, how hard will it be for you to have conviction when the market sells off like we're seeing right now, Joe? If you haven't at least done that basic bare minimum due diligence to have that confidence that you're okay owning that company, when even though it's falling 10% and then it's falling another 10%, you're not going to have any conviction, no conviction. And then you're going to get emotionally chasing your tail in your decision making.
Absolutely. So I want to do kind of a bit of a clumsy transition here, I'll admit. But I've been doing a little bit of due diligence this week about this new ETF, Buzz, which is, I forget what it's called exactly, but it's VanEck something
Social
or other.
Sentiment something or other.
Yeah, and there's some, I've seen very mixed reactions about this, and people seem to not really understand it, because I think when people first heard about it and they heard that like Dave Portnoy was behind it, I don't know, personally I was like, uh-oh, here we go. I'm not a big fan of Dave Portnoy, and so I started to look at their holdings, and I was like, oh my gosh, I own a bunch of these already. Long story short, what day did it start trading? Was it yesterday or was it Wednesday?
Yeah, it was either Wednesday or Thursday.
Yeah, one or the other. I don't remember. It's been a long week.
Days blend. It's been a long year.
I went out and bought some on that first day because I was like, heck, I think this is great. So I just wanted to spend a minute to just kind of go over what the heck this Buzz is, because frankly, I hate to say it, but it is all the buzz right now in the FinTwit world. And I don't know, I haven't really been watching Wall Street Bets all that closely this week, but it's certainly been getting a lot of attention. So Todd, what do you make of this? Is this a good investment? Are you concerned about how they're picking the stocks in it?
The machines are coming for us, right? The machines are rising. The algorithms, it's a natural extension.
It's fascinating, isn't it?
Yeah, I mean, if you think about it, I guess you could make the argument it's kind of leveling the playing field in a way, right? Because most of these big hedge funds and asset managers have access to these social sentiment tools internally, and they're using those. You may not even realize it, fellow FinTwitters, but as we enter in and talk about stocks, you guaranteed that we're part of a fire hose, and that fire hose is spraying ideas into these big funds. including Citadel and others. You know, and they're using that information to create, you know, programmatic trades. Chris Camillo, I believe is his name, he started a social sentiment Twitter kind of product for institutional investors years ago. Great talented trader who's talked about in the Jack Schwager's latest book, The Unknown Market Wizards. And a really fascinating story about, you know, being early to the idea of, okay, well, let's crowdsource ideas to own in our portfolios. And, you know, how can I make my crowd more intelligent? Well, I can make my crowd more intelligent by going outside of just the 5 people who are in the room with me. You know, I can look at millions of people and see what everybody is saying. And maybe that's how I learned that purple mattresses are taking off and everybody's buying those, or Pelotons are, you know, in vogue or out of vogue or whatever. And I think what we're seeing with Buzz is now we have a product that's available to individual investors that allows them to I guess, the same benefit of being able to crowdsource ideas from this larger, broader community. The downside could very well be that the information now is going to be diluted, right? And the value of that information is going to be diluted because so many people are now going to have access to it. So then it's going to become about speed. How quickly can you rotate from one idea to the next idea? And honestly, Joe, I have not looked to see how often they rebalance this new ETF. So I don't know if it's rebalanced monthly or weekly, but it would probably be something that's worth knowing.
I believe it's monthly. I assume that's what it means when it says index reconstitution.
Okay, so yeah, I mean, it's definitely actively managed then, and yes, it's definitely rotating its portfolio. But the question again is going to be how stale is that information versus the information that is available elsewhere. I think what will also be interesting too is whether or not there's any overlays that are kind of working, and we won't know for a while, right? We won't know for a while. But I mean, like if you look at our research, we've been recommending financials, industrials, and energy stocks for months, right? So, but when I look at the social sentiment holdings of Buzz, I mean, what kind of stocks do you have the holdings up?
I do actually, yeah. I'm scrolling through it right now, and
I have a feeling they're mostly going to be kind of aggressive techie kind of stocks, but maybe not.
You'd be surprised, actually. That's kind of what I was thinking when I first heard about this. I thought that it was going to be like GameStop, AMC theaters, like all these new SPACs, stuff like that. Like I thought it was going to be like Reddit sentiment ETF. Luckily, I've since found out they don't, the AI that they're using doesn't even comb through Reddit. So the way I see it, that's a good thing. But their top holdings: Ford, DraftKings, Twitter, Facebook, American Airlines, Amazon, Apple, AMD, Netflix, Tesla. It's kind of all over the map. But generally speaking, there are not a lot of, I guess there are a couple of energy stocks in here. ExxonMobil's in here. Yeah, there are some industrials. They've got GE in here. But honestly, the way that I see this as a frankly an excellent way for me personally and other retail investors out there to get exposure into a lot of stocks that I've been looking at for a long time, but haven't pulled the trigger on for one reason or another, because I'm worried about volatility or, you know, their immediate future. I'm looking at like DraftKings and Tesla specifically, and I saw the list of holdings before it traded, and I was like, I gotta just gobble this up. There are a lot of really good stocks in here, and there are a lot of stocks that are high scoring in our research as well. A couple that jump up are BlackRock, Visa, and Shopify. So
yeah, I love BlackRock.
Yeah, it's not so. The reason I wanted to bring it up is because it's not necessarily what you think it is, and I honestly think it's worth a look, because there are some kind of questionable ones in here. Nicola, however we're pronouncing that, Beyond Meat, but still it's balanced with names like Goldman Sachs and Salesforce and Google.
And
So,
I think, Joe, if I remember correctly, the weightings aren't crazy. Like a lot of those weightings, I think, are only like 2 or 3% or even less. Some of them are less than 1%. So, I mean, you own maybe 80 names or something like that.
yep. Yeah. So the biggest holding is Ford, and it's 3.39%. It's not big. So like some of those that I was listing are like 0.5%.
0.5%. Yeah.
Yeah.
And the other question that I had for you, Joe, and no listeners, we're not a shill for this policy. We'll leave that to Portnoy. This isn't an ad for this ETF, but it's curious, and it's interesting development for the marketplace. And one of the things that's interesting to me about it is to your point. Let's say that you have a limited pile of capital or time, right? You could say to yourself, okay, well, I'm going to mess around the edges, and with these individual stocks. But I'm also going to buy the Buzz ETF because I'm going to get exposure to 80 different stocks or whatever that are, in the news that people are talking about or whatever, and get some amount of diversification that way, idea diversification that way. And I think that makes sense. And I don't think that the management fee is stupid. I don't know if you have that screen up as well, Joe, or if you know what the fee is.
The expense ratio is 0.75%.
How much?
0.75.
Yeah, of course, I've got a lot of gray hair. I remember when, it was 2%. And then, of course, if you talk about hedge funds, it's 2 plus 20, right? So, I mean, I think that, to pay 0.75% for something like this, may make sense. I think that we're just going to have to watch and see whether or not, how often they reconstitute the portfolio, and if there's a time lag on problem with that, and, kind of play it out from there, but it's interesting. I'm glad you brought it up.
Yeah, it's going to be interesting to watch. It's been down a little bit or quite a bit, depending on your perspective in the first couple days of trading. But I'm not too worried about it. I think that overall the stocks that are in it are pretty strong, and I think that they have a bright future. I just noticed a couple more that really make me optimistic. AMD is in here near the top, as is Pinterest. So I know we've talked about Pinterest on the show before.
Yeah. And AMD is high scoring as well in the research.
Yes, it is. Yeah. So that was really all I wanted to talk about buzz wise. Are there any stocks beyond the buzz holdings that we just talked about that you want to throw in there before we wrap up?
Well, what I'd like to do real quick as we end up the show is just go real quick to show everybody what the latest research is. And what I did is I went to the Seeking Alpha site. I went to Top Stocks for Tomorrow, which is Limelight Alpha's service. And I clicked on the best and worst large cap stocks report that went out today. And Joe, you can see that okay, yeah?
Yep.
All right. So, I mean, this is where you can build your watch list. And as the market digests this craziness that we've seen this week, kind of figure out which of these names you might be interested in including in your portfolio. Strongest sector right now is financials. Okay. And what's funny, I don't know if it's not funny, right? But I mean, if it's funny, if you look at, JP Morgan and Travelers, for example, I mean, you say to yourself, okay, well, what correction, right? There's JP Morgan's chart, right? You can see that, Joe?
Yep.
And then you look at Travelers, what correction, right? So, I mean, I think you can look at some of these leaders and say that, yeah, this is that business cycle rotation we were talking about at the top of the show, where some baskets are doing much better than say the technology basket. It's just that so many people are in that technology basket, it feels like the market is doing worse than it may otherwise be. You look at a name like Carlyle, for example, holding the 21-day moving average and looking pretty good. You could take a look at like Textron and say, okay, look at that. It's still in its pivot level. It's still starting out sideways. What correction? I don't know what kind of correction you're talking about. So, financials, industrials, and there's a bunch there. You can look at energy. And I tweeted about Valero the other day. Again, Valero asks, what correction? Here we are rallying and rallying and rallying. And we do still have technology scoring above average. So there are some stocks that you might want to take a look at there. And one that jumped to mind for me was Servicenow, which is a stock that I own. And you'll remember from my show, I like to look at that 21, I like to look at the 50-day, and then I like to look at that 200-day. And right now, today, we touched and slightly undercut that 200-day. If we can hold here and build off of it, I think that that could be a good entry point for this stock. It's certainly a company that's successful, 31% year over year revenue growth, EPS in 2022 looking to grow 29%. They basically provide the software to enterprises that allows work to get done within those enterprises, and certainly have had some success. So, yeah, I mean, just because the technology stocks are the ones that are most beat up, though, doesn't necessarily mean that that's the only place in the market you should be looking, because a lot of these other baskets will have some staying power. And sprinkling the infield with some of these other names from these other high scoring sectors can really help out your performance, especially during periods like this. Like all week, at the top of my screen were energy stocks. And I'm like thankful that I owned a couple energy stocks to at least brighten my day as my technology stocks were getting slammed. So so there was just a few things to keep in mind as you go forward for the week.
Yeah, absolutely. And I think we'll leave it there. So please make sure that you do your research, do your due diligence, follow those steps that we laid out. And yeah, we'd love to hear what you guys come up with. So feel free to send us a tweet, drop a comment, whatever works best for you. We look forward to hearing, and we'll be back next week. Take care, everybody.